mode.
Good morning. Thank you all for attending today's webinar regarding the SEC Risk Alert and a Guide to Third-Party Due Diligence Best Practice. My name is Sabrina Barilli and I manage the Due Diligence Division at Cordium. Together with my colleague Wendy Torres, who assists in the management of our department, we will be discussing some key observations noted in the recent SEC Risk Alert relating to due diligence processes used by investment advisors who recommend or place clients' assets in alternative investments. At this time, I would like to remind you that if there are any questions that you might have throughout the duration of the webinar, please feel free to submit them in the question panel within the GoToWebinar application, and we will attempt to address them at the end of our presentation. As noted in the agenda outline, we will be discussing the OCIE Risk Alert. We will further address staff observations as related to the advisor's use of third-party service providers to validate information and conduct due diligence checks. Those checks extend to service provider verifications, independent background checks, and regulatory history reviews. We will also go over some noted improvements to the due diligence process that were observed. And those included more advisors conducting legal document reviews, evaluating terms and issues for potential risks, and how all advisors had either an informal or a formal due diligence framework in place. We will also touch upon some deficiencies identified and outline some due diligence best practice for consideration. Again, at the end, we will follow up with any questions and provide any answers. So let's start with a general overview. As you may all be aware, the SEC's Office of Compliance Inspections and Examinations, which we will refer to throughout the presentation as either the OCIE or the staff, they recently issued a risk alert entitled Investment Advisor Due Diligence Processes for Selecting Alternative Investments and their respective managers. In it, the staff highlighted industry trends, improvements, and deficiencies they had observed during their examination. For anyone that has not yet had an opportunity to review the risk alert, it can be located on the sec.gov website. We have included a URL on the slide handout for your reference. So let's discuss the focus of the examination and the basis for the risk alert. The OCIE staff noted that they had examined the due diligence and related investment advisory practices of advisors. They wanted to evaluate how advisors were performing their due diligence of alternative investments and their managers. They wanted to see how advisors were going about disclosing and mitigating potential conflicts of interest. And they wanted to evaluate how they were describing their alternative investments and their fund structures. The risk alert highlights the findings of the OCIE during their examination. In it, they reviewed more than 10 SEC-registered investment advisors to pension plans and fund of private funds that either managed or recommended private fund and fund of private fund investments. Based on their observations and on outside studies, they noted that investment advisors were increasingly recommending alternative investments to their clients. The OCIE staff recognizes that due diligence of alternative investments can be challenging. And while there's an increased regulatory focus on alternatives, it's important to note that alternative funds may not be easily valued or marketable and are often illiquid. As such, some advisors may short out on their due diligence efforts when they invest in alternatives. So while the risk alert notes that the staff does not take a position regarding the effectiveness or the ineffectiveness of the industry practices discussed and observed, we can make note that during past SEC actions, advisors failing to conduct adequate due diligence were sanctioned. It seemed to indicate that the SEC is closely monitoring the sufficiency of due diligence disclosures and measures being taken by advisors. Some of you may recall the SEC enforcement action against the investment advisor Hennessy Group. I think this dated back to 2009. In it, Hennessy Group had promoted their process for evaluating and selecting hedge funds. They had even called them the 5-level due diligence process. They represented this to their clients and their prospective clients and noted that they would not recommend any investments that did not satisfactorily complete all 5 levels of their due diligence evaluation. Hennessy Group, however, failed to perform all phases of their due diligence that were noted, and as a result, they made recommendations to clients that invested and were later determined to be fraudulent investments. According to the SEC settlement order, the Hennessy Group and its principal owed fiduciary duties to their clients not to misrepresent the services that they were providing and to disclose all material deviations from representations that they had made. Their failure to comply with due diligence practices that they had noted to clients resulted in this enforcement action by the SEC. And this should be a clear indication to investment advisors that you should expect to see increased scrutiny of due diligence practices. If you're going to note you're doing something, you need to follow through and do it. Some of the practical considerations that were taken from the Hennessy case and that appear to still be in line with the industry trends and deficiencies recently noted by the staff during the examination included reviewing representations to clients and due diligence materials. Ensure that the steps taken to review potential investments correspond to those that you're representing in your marketing materials. Secondly, obtain all appropriate underlying documentation. You want to check for any conflicts, any misrepresentations, any non-disclosures. Directly confirm your service provider relationships, and this is something Wendy will go in a little bit further. Follow up on any potential red flags. Are there any unknown service providers, inconsistent statements relating to material facts, or potential conflict of interest between the funds and their service providers? Periodically, you want to review due diligence processes that you have in place, and you want to be sure that there are no potential discrepancies that still exist. This SEC enforcement action and the current SEC examination alert are both aimed at due diligence practices amongst advisors. They reinforce the fact that we're living in a culture of accountability, and due diligence is no longer an afterthought but a preemptive step required by all. Advisors have a responsibility in their fiduciary capacity to act in their client's best interest, taking into consideration the increased regulatory oversight as well as the client demand for greater transparency. There should be an expectation that they will provide full and fair disclosure of all material facts, that they will take reasonable care to avoid misleading their clients, and that they will provide a duty of care. And while there are a number of staff observations throughout this risk alert on many different due diligence fronts, because as we know, due diligence is multifaceted, for purposes of this webinar, we will be narrowing down the focus of our discussion to just those key industry trends and those deficiencies that we've already outlined in our agenda for today. So throughout the course of our discussion, we're going to be following up on each staff observation, noting some suggested best practice guidelines for consideration and how we can help you build out your own internal due diligence framework. So let's discuss further one of the really key topics and one of the main observations is that advisors are utilizing third parties to supplement their analyses and to validate information regarding alternative investments. In such service capacity, the staff noted that advisors were looking to supplement and validate their information. This included confirming service provider relationships, performing thorough background checks on managers and personnel, conducting independent verification checks, and reviewing regulatory histories. Because these third parties play an important role in the due diligence process, as a matter of best practice, you should periodically review those third parties as well. Some of the reviews conducted should include asking whether or not they possess the level of expertise that is required. Do they have any regulatory or legal matters pending or pre-existing that might damage you on both a business and a professional reputational level? And are they abiding by the terms of their agreements and their responsibilities? You want to determine how often you're going to go about reviewing these third parties. Will it be monthly, quarterly, annually? Are their policies and procedures in line with those of your own? What duties will they be assigned, and what will remain in-house? And also, who's going to assume the supervisory obligation of overseeing not only the third party, but the entire due diligence process as well? You want to establish these as working guidelines to assist in making sure that your internal and your client due diligence expectations are adequately being met. At this time, I'm going to turn to Wendy, who will further discuss some of those third-party service provider verifications and observations made by the staff during their examination. She'll outline some suggested business best practices as well.
Thank you, Sabrina. Hello, everyone. I hope everyone's having a fantastic day. This is Wendy Torres, and as Sabrina mentioned, I'll be discussing some best practices for verifying service provider relationships. The OCIE staff observed that many advisors were independently verifying relationships with key third-party service providers. If the advisor wasn't familiar with a service provider, a certain amount of due diligence on the service provider would be conducted to validate their adequacy. As some of you may recall, the Bayou Fund fraud scandal that occurred about a decade ago taught us a valuable lesson about the importance of confirming service provider relationships. Bayou actually attempted to conceal their losses by creating their own accounting firm, which was founded by their very own CFO. The CFO issued fraudulent statements to their investors and misrepresented who their accounting firm actually was. While they claimed to still be working with a well-known, reputable accounting firm, the firm had long ceased working with them. So what are some best practice guidelines that we can take away from a case such as this? Well, essentially, we can confirm current relationships. We can contact the service providers directly, confirm current relationship with the fund and when they were initially engaged. If possible, try to get all this information in writing. If they happen to respond via telephone, be sure to capture all the important details of the call, including the rep's name and contact information. You then want to cross-check this information with what the fund has actually provided. If a service provider has a non-disclosure policy for third-party service providers, get that in writing as well, and follow up with an attempt to confirm directly. This may entail involving the fund and the service provider in the release of such information. It may be a hassle, but they should already expect this from investors. If they are still hesitant to confirm their relationship, you may want to determine internally how this impacts your investment decision and your risk assessment. Next, you want to check for potential conflicts of interest. Confirm that the service provider is indeed independent. Some further enhanced due diligence may be required to determine if there is a strategic partnership between the service provider and the fund or the fund's key personnel. Independent administrative services help mitigate certain potential conflicts of interest, such as investment and operational risks, and the misappropriation of investor assets. Such independent administration helps ensure that there are clear segregation of duties. And finally, you want to conduct further research into any lesser-known service providers. Verify their corporate status, confirm their professional licenses, check for any disciplinary or regulatory status, and check for any adverse media or litigation. In addition to confirming the legitimacy of the legitimacy of a service provider, proper due diligence measures help minimize any possible reputational risks or potential negative impact should the service provider associated with the fund be found to have engaged in fraudulent activities, or if they're currently engaging in fraudulent activities. We also advise that service provider confirmations be conducted periodically. So let's say there are multiple changes in service providers over a short period of time. That should definitely prompt further inquiry. So you constantly want to be on top of confirming these different relationships, especially if they do change service providers multiple times. Next, I will go into the details of the independent background checks and the importance of background checks. The staff also observed that most advisors employ the services of third-party firms to conduct comprehensive background checks. A thorough analysis of all findings located should be conducted by professionals with experience. You can consult a firm or hire a firm such as Cordium to do this type of work. The third-party firm should be able to locate and identify any red flags or derogatory information. And connecting all these different pieces will help depict quite a telling story about the fund and its key personnel. So having professionals in place put all the pieces together will give you a greater picture into the fund and the people that are actually managing the fund. For example, from 1995 to 2008, Thomas Peters, a prominent manager in Minnesota, ran a massive Ponzi scheme through the sale of promissory notes to investors. This $3.65 billion fraud remains the third largest hedge fund fraud case in history. This is one of many examples in which background checks should have helped investors avoid such a lucrative investment. An extensive background check on Mr. Peters would have resulted in several felonies, including a 1983 conviction for writing bad checks, a 1989 conviction for forgery, for which he served time in prison, and a 1990 conviction for the theft by check. In addition, Mr. Peters even lied on a Dun & Bradstreet questionnaire about earning a degree from St. Cloud State University. In the alternative investment community, it's extremely important to identify any indicators of fraud and other adverse information that could negatively impact investors, as we saw in the case with Mr. Peters. At minimum, research should execute the following preliminary background checks. Confirm that the entities exist, are in good standing, and that all required formalities have been adhered to in connection with the formation and operation of the fund. Verify employment and educational histories that's related to the key individuals under review. Review news articles, social and media websites, naming or linked to the entities and key individuals being researched. Conduct public records research for adverse records, such as those related to bankruptcies, judgments, tax liens, UCC filings, civil and criminal filings. Review the key individual's assets, such as multiple property transactions or foreclosures. Verify key individuals' regulatory and professional licenses and certifications. Check for any regulatory records, violations, or disciplinary issues that have not been disclosed. Ensure that proper security filings have been made and that any disclosures noted conform to other information that is publicly available. And finally, run a profile search of the entities and key individuals under review against any anti-money laundering watch lists. In addition to running background checks, validating information as provided by managers of alternative investments is just as important as researching for new undisclosed information. A number of administrative proceedings, complaints, and litigations filed in the past year have included allegations related to the investment advisor's due diligence. As such, asserting proper due diligence would have prevented investments involving Ponzi schemes, insider trading, or other serious frauds. Actions have focused on false and misleading statements in the advisor's marketing material or offering documents based on the level, scope, or quality of its due diligence. Others have also noted the absence of well-documented due diligence reports and the absence of active monitoring of such procedures. As such, the following should be standard practice. As I mentioned before, good standing checks on the funds, educational histories on key personnel to confirm the accuracy of the information provided by these individuals, employment histories on key personnel to verify previous and current employers, dates of employment, accurate job titles, reason for leaving if available, or any gaps in employment. Regulatory and professional licenses and certifications to validate the current status, the license number, the year obtained, or any disciplinary actions. Individual credit report checks to review creditworthiness and cross-check against any property transactions, judgments, liens, or bankruptcies picked up during public records research. And finally, a review of enhanced disclosure forms such as Form ADVs and SEC filings, which I will go into detail, to ensure that proper security filings have been made and that all disclosures have been accurately captured in these forms. Next, I'll go into the regulatory history review and go over some of those ADV filings and SEC filings that you can look at. The staff observed that some advisors utilize the FINRA broker check, which is a publicly available tool, to research the backgrounds of current and former FINRA registered brokerage firms and individual broker dealers. Along with broker check, the staff also observed that some advisors reviewed regulatory filings such as Form ADV. The FINRA broker check disclosed educational, employment, and disciplinary backgrounds of current and former individual brokers and FINRA registered brokerage firms. On the website, advisors can actually check for registrations, adverse filings, investor complaints, and educational and employment histories. The staff also observed that some advisors reviewed regulatory filings such as Form ADVs for managers' histories. And as you can see in the slide, there's a link to the website so you can access these filings directly. You can view a manager's most recent Form ADV online by visiting the IAPD website. The Form ADV Part 1A can help investors assess if the manager or its affiliates have incurred any regulatory or civil litigation within the past 10 years. So that information stays within the filing for 10 years from the time in which the event occurred. The Form ADV Part 2, or as they refer to it, the brochure, outlines information on the advisor's business practices, fees, conflicts of interest, and disciplinary information. So this is also a very valuable form that you can access. Intentional misstatements or omissions in these forms constitutes federal criminal violations. As such, it is extremely important for managers to verify the information found in these forms. If there are any discrepancies, you can immediately alert the SEC. I will now pass over the presentation to Sabrina as she discusses improvements to the due diligence process. Thank you, everyone.
Investment advisors have always focused on operational and legal due diligence, it appears that some advisors are enhancing their focus in these areas. As noted in the risk alert, an advisor that exercises discretion to purchase alternative investments on behalf of their client or that relies on a manager to perform due diligence of alternative investments must determine whether such investments meet the client's investment objectives and are consistent with the investment principles and strategies that were disclosed by the manager to the advisor. This is sometimes noted in the various documents, such as the advisory disclosure documents, private offering memorandum, prospectuses, and other material that might be provided. In an effort to detect legal document risk, advisors should request and should review all available documentation. And while not an exhaustive list, generally speaking, this should extend to a review of offering memorandums and prospectuses, as well as subscription documents. Some things you want to look at, some questions you may want to ask are, do you have the most current version available? Are the investment objectives and strategies clearly identified? Are there any risks or conflicts disclosed that should have been followed up on further? You want to review governing documents such as the investment management agreements or articles of incorporation. Sometimes this information within will be a little more in-depth than that which is noted within the offering memorandum, and you want to make sure that they're consistent throughout. Due diligence questionnaires and marketing material are also important, and while often viewed as more pitch books, you really do want to check whether or not information has been consistently disclosed within. Do they note the fund's structure, their strategy, risk controls, managers and operations? Are they the same as those that you previously reviewed in the offering memorandum, in the articles, in the investment agreements? Organizational charts and biographies of principals are also important, and while sometimes they can be publicly available, you want to see whether or not there's a more robust version available. As Wendy noted, it's important to make verifications of not only information provided, but information and fact check what you can with what's out there and publicly disclosed. You want to know whether or not the personnel have sufficient knowledge about their strategies. Is the proper segregation of duties assigned with the proper compliance, portfolio management, operations, or business management personnel? In reviewing financials, if they are available, you'll want to look at the past 3 years and any valuation policies that may be available. Are all expenses transparent? Is the valuation process fair and robust? Are valuations independent of the investment manager? And additionally, as Wendy already noted, you can review the Form ADV. Sometimes this will be provided to you, but if not, you can also obtain this publicly available on the SEC website. It's under the Investment Advisor's Public Disclosure section. That form is really helpful because it provides a description of the firm, funds, assets, manager's backgrounds, and includes important disclosures and identifies any affiliated entities or any relative adverse findings that might have been obtained during a prior SEC investigation. Gathering all that data and putting it together, you basically want to look at whether or not any previously disclosed public filings that you have retrieved and any of those that you have obtained directly from a manager, are there any discrepancies, gaps, or potential misrepresentations? Ask yourself if they're consistent with the description of terms amongst the various disclosure documents and the formation documents. Are they false or misleading? Are there any undisclosed potential conflicts of interest or fee arrangements that have not been previously discussed? And importantly, are the terms in accordance with industry standards? Do they meet the client's objectives and their guidelines? And are there any structural anomalies or unique operating terms that might require further definition? During their examination, the staff observed that advisors' due diligence teams tended to focus closely on terms revolving around liquidity and redemption. According to the alert, advisors appeared to be a little more sensitive to the liquidity parameters of the underlying managers' portfolios, as they wanted to ensure that they corresponded with the liquidity terms of their own alternative investments. Beyond liquidity and beyond redemptions, a critical review of offering documents should focus on the following key terms as well. Strategy and structure. Are the investment strategies and fund structures complex? What types of securities are being held? What are the position concentrations? And are they consistent with the stated strategy? With regards to fees and expenses, are there any fee structures in place? Are they fair and according to industry standard? And are the appropriate parties responsible for their payment? Are investors subject to a lockup period? If so, are there any fees imposed for early withdrawals or redemptions? Is the payout schedule on withdrawal and redemptions made timely? Or are there any holdback provisions? You also want to look at any eligibility issues that might be there, as well as conflicts of interest. Are there any undisclosed conflicts such as compensation arrangements or business activities that have not been previously disclosed? There are many different levels of due diligence to be conducted. And in addition to the investment due diligence and the background due diligence, which we already discussed, it's also important to conduct an on-site operational due diligence check. The OCIE observed that advisors were conducting more on-site reviews than before. And these visits were important to the process because they provided them an opportunity to confirm findings that had been made. Taking a look beyond just a review of the terms and the strategies and evaluating internal operations, this allowed you to get a better look at the management, key personnel, and basically the entire compliance process. You had a more well-rounded review when you were on site. Noted improvements to the due diligence process also included the fact that examiners, all advisors that had been examined, had either a formal or an informal due diligence framework in place. And although the advisors examined generally did not include such due diligence policies and procedures in their compliance manuals, the staff did observe that the advisors were more likely to have due diligence processes that were consistently applied if they had adopted written policies and procedures that were detailed and that required adequate documentation. Developing and maintaining a proper due diligence infrastructure and record-keeping system for both potential and ongoing investments is essential. It helps build a level of trust and transparency that investors are looking for. Generally speaking, a framework should include designating a proper supervisory person who's going to be overseeing the entire process, a review of internal resources. Do you have them, or do you need to appoint a third-party service provider with specialties and expertise in performing those duties? Are policies based on best practice with the goal of satisfying regulatory requirements and expectations? And are they tailored to meet internal needs and operations? Is due diligence clearly documented, and is there a clear record of any risks findings, issues, and follow-up measures being taken? Building out a risk management tool is important. You want to determine what meets and what fails certain criteria. And of course, periodically you want to monitor those due diligence policies and procedures that are in place in an effort to catch and promptly address any potential risk. The staff did observe that in addition to some of the notable improvements, they had also observed some deficiencies. And the risk alert draws attention to some of the control weaknesses that they observed during their examination. This included some advisors who had omitted alternative investment due diligence policies and procedures from their annual reviews, those who had due diligence practices that differed from what they had already disclosed to clients, and marketing material that included potentially misleading information about the scope and the depth of the due diligence. If you'll note, going back to the discussion on the Hennessy group, a lot of these deficiencies and observations already made and disclosed were those that were also observed in the Hennessy Group Enforcement Act. So taking away from that, you can see that the SEC is being really clear about what it is that they want to target in and focus in on and what their expectations are from a due diligence front. Summing all things together, advisors recommending alternative investments should review these industry trends, look at the deficiencies highlighted in the risk alert, and determine, are there opportunities to improve upon either your formal or informal due diligence programs that do exist. You need to understand that each review must be tailored to fit your own specific strategies, your investor base, and your operational jurisdiction. And while written due diligence protocols may not be formally required to be incorporated within a formal compliance manual, due diligence policies and procedures that are in place should be reviewed annually. They should be consistent with the advisor's fiduciary responsibilities to their clients and any disclosures made, and they should be consistent with representations made in any marketing material or offering documents that are in circulation and that may be relied on. As a reminder, advisors have a responsibility in their fiduciary capacity to act in their client's best interest. Taking this into consideration and the increased regulatory oversight, as well as the greater demand for transparency, the expectation should be that they will provide all advisors full and fair disclosure of all material facts, taking care to avoid any misleading of their clients, and provide a duty of care to them. At this time, we'll address any questions that might have been submitted in the GoToWebinar console. I'll address the first question. Who should be appointed to conduct due diligence? Well, conducting thorough due diligence, it's not a one-person job. there are a number of professionals with different levels of expertise that may be required. That could be an operational due diligence group who may be assigned to review the legal documents, may be assigned to focus on the liquidity issues at hand, expand their review of the audited financial statements, and conduct those on-site visits to managers that we know are important. Another level of due diligence rests with those who are part of, an investment team. Have they evaluated the complicated strategies and structures of any potential investments? The independent third-party service providers are also key to a due diligence process. As we discussed, they do help in conducting comprehensive background checks on managers, validating information that's out there, retrieving information that may not be publicly, may not be provided by a manager but is publicly available, following through on any sort of discrepancies, whether it be in a bio or in an offering memorandum that might be provided. And then you have your risk assessment team, and they're going to review and analyze the overall exposure that might be out there and whether or not, there's certain criteria out there that may not fit within what the internal policies and procedures in place require. Wendy, I think there's a question regarding auditors.
Hi, Sabrina, yes. Tom asked if, as far as auditor confirmations are concerned, is there any additional information that we can obtain other than just confirming the actual relationship? And Tom, as far as that's concerned, most of these huge auditors, the PwC and Ernst & Young, they do have non-disclosure policies in place, so it makes it extremely difficult for us to obtain any further information other than the fiscal year in which they're engaged and the name of the funds that they're engaged with, and possibly the and when they expect to be engaged with the fund. So as far as the scope of their engagement, we don't really get that much information from them. If you do get pushback from the auditors, you can always involve the fund and the investor so that they're able to get all these non-disclosure forms filled out, and you can get additional information. You can actually get their policy in writing as well, so that if the SEC, if you're ever audited, you have that already written down that the the auditor didn't provide the information that you needed and that they do have a non-disclosure policy in place.
Thank you, Wendy. We had another question regarding best practice for frequency of on-site visits and whether or not that's annually. It's been our experience, based on our clients, observations of our clients, that they often conduct on-site visits prior to an investment. They want to basically collect any sort of information that may be available out there on the managers and the key personnel and the funds themselves, and then conduct their on-site visits to determine whether or not there's any follow-up questions that may exist or areas that may need to be further developed. And from that point, they usually conduct an annual review on-site, as well as an annual review of any sort of previous background checks that might have been conducted on all parties, and that includes all key personnel as well as any of the managers and any of the funds, to confirm whether or not they're still in good standing, whether or not there have been any sort of regulatory actions that might be out there, or any sort of information that might have occurred within the past year from the last time that an on-site visit took place or the last time a due diligence check was performed. It's also important to, at that time, to make note and to follow up with whether or not service providers have changed. You want to confirm this information to determine whether or not they're still actively building out a relationship with the funds in place, or whether or not that too has changed. So I would say periodic checks on an annual basis are definitely recommended on-site as well as behind the scenes.
We have another question. Do you recommend doing background checks on all managers, or only with managers that you commit a larger sum of capital to, perhaps, for example, a private equity commitment greater than $300 million? To answer that first question, we do recommend background checks on all managers. We actually have a couple of private equity clients. and also funds that invest in private equity. So we definitely recommend that you conduct your due diligence on all managers. And for the second question, do you recommend checks on just the most senior level professionals like the investment committee members? I guess it depends. We do conduct research on senior level execs as well as anyone involved in any major investment decisions. So I guess any managers, any principals, anyone involved in the investment process.
Thank you. Another question is whether or not we speak with the fund's board of directors. On our end, we don't speak with them directly, but we do conduct due diligence as requested. They do play an important role as well, and we may look into whether or not they're sitting on too many boards, confirming their relationship with those boards that are in existence, determining whether or not they're independent from the manager themselves. Those are checks that we do conduct, and that's along with any sort of key personnel that may be out there, such as the CFO, the COO, any of the portfolio managers. Another question we had are credit checks of key managers a best practice? This all depends on what you internally deem to be your best practice. We do know that a lot of our clients that are involving themselves in a new investment may want to conduct a credit check. They want to see if a manager is able to basically maintain their own sort of, credit worthiness, and whether or not they're going to be managing your own, if they can basically carry that over, personal and professional. So those credit checks are often confirmed on our end. However, that really depends on the comfortability and your internal policies and procedures regarding that. Moving around that, I will say that a lot of the credit checks do sort of check for things that we can find through publicly accessible information, such as judgments and liens, or if they have any sort of bankruptcies and those come out in a credit check. You can also find those during a public record search as well. So really you're using a credit check on that end to double confirm what might be out there through other publicly available databases.
Okay, we have one final question, and that's how often are background checks refreshed post-investment? We usually, it depends on the client, but we normally do either biannual updates or we do annual updates, which includes research from the last time that the original report was completed. And we do so for every year. So we update everything from the key individual's background information to the fund's background information, SEC filings, ADVs, and anything of the sort, AML sanction checks as well.
Well, this session is currently recorded, and the presentation is available via email and on our website post-session. If there are any questions that we have not had an opportunity to address, we will follow up post-session. Thank you all for attending today. We're very happy to assist you as best as possible. And again, feel free to submit any questions you have, and we'll address them at the end. Thank you.